Hello everyone, a warm welcome to Global Online Platform. I am Rahul sir, your management educator. Today we are here with a crash course on Unit 5 of Financial Management, one of the most important unit. After watching this crash course, here we are going to cover all the 100% sure topics of management. After watching this crash course, you will feel confident about this unit and you will be able to score good marks from this unit. We have targeted those topics from where NTA always asks questions, and after watching, I guarantee you that you will understand these topics and able to attempt answer these questions accurately. There is an important information for you that we are offering the UGC NET Paper 2 Management course. If you take the course, you will get complete video lectures, full syllabus notes, test series and PYQ PDFs with detailed explanation. This is going to be your target based preparation. The main advantage of this course is if you take the Paper 2 course, you will get Paper 1 course totally free. You just have to download the global online app. Our official, this is our official logo. After downloading, you just log in and you will see the home interface. In the home interface, you see the second button from the left corner, that is store button. You have both the options, that either you can search in the search box UGC NET Paper 2 Management, or just after scrolling you will see the course UGC NET Paper 2 Management. Just select it, and after paying you can access all the contents in number of times. This course is very structured and very comprehensive. This is the right time to take this course because the exam is very close. Point 1. Let's understand what is capital budgeting. Capital budgeting is the process of making investment decision in the long-term assets. It is the process of deciding whether or not to invest in a particular project. All the investment possibilities may not be rewarding. What happens? Generally, capital budgeting is subjected to, first thing you should remember, that it is related to investment decision. Three elements we had discussed: FDI, so it is subjected to investment decision. Then what type of investment? Long-term investment. And later on, here the projects are evaluated by using multiple techniques, and because we have to select the best one, whichever project is best for us, we have to select one, because all the opportunities which we are getting will not give, it is not necessary that all will be beneficial. Anyone or any one of these which will give an optimum benefit to us will be this opportunity we have to select, for which we use the capital budgeting concept. Okay, so let's understand some examples. At what time we will use capital budgeting. So if you have to do day-to-day operations, expenses, you will not use capital budgeting. Capital budgeting is used for long-term projects, large, which requires huge investment. So here the first point is expansion of business in other geographical area. Suppose here a business is located in the Mumbai, and you have to open a new branch in Amravati district. So here what you will do, you will plan a capital budget to do that, how much investment is required, what location should be there, everything you will plan and invest your money according to, for expanding your business from Mumbai to Amravati. Then replacement of an obsolete equipment. Obsolete equipment is which is damaged to some extent. It is not getting properly utilized by and giving the optimum output which it should give. So at that time we will replace such equipment, and this is at this time because the equipments are very costly, so we need to use capital budgeting. Then new product or market development. If you have to develop any new product, add any innovative feature in that product, then at this time you will plan or develop a market for your product. At this time you will use the capital budgeting. Then research and development. This is a common thing that in research and development regarding any any field of the management or marketing or operations, anything. So we have to do research which requires huge money. So at that time we will use capital budgeting. And re-engineering, whenever you want to completely renovation of your business, at that time you will use capital budgeting. So these were the examples where capital budgeting is utilized. Now let's understand the nature of capital budgeting. Nature of capital budgeting, it involves high cost. As you know, as I told earlier, capital budgeting will be used for high cost projects only. Then this is a high, there is a high risk in capital budgeting decision, and the expected return is high. It's the principle of finance that wherever the risk is high, the return will also be high. So in case of capital budgeting, because we are investing a large amount of funds, so there is risk, but this risk will also give return. Then it is used only in case of long-term projects and long profit estimation. Capital budget, remember this, if you find any statement in the exam that it is used for both long-term and short-term, that statement will be totally incorrect, because it will be used in case of long-term projects only. Then it is considered the application of funds. Here what you are doing, you are not procuring funds, you are not financing, you are utilizing the funds. Then therefore this point is mentioned that it is used as application of funds. Then capital budgeting decisions are irreversible. Suppose in case a person marries a girl, then later on, after a few years, he find that they are not ready to adjust with each other, they will take divorce. But in case of capital budgeting, the decision which you had taken is irreversible. Once you invested, you lost. So you have to the capital budgeting decisions are irreversible. You have to take them very cautiously. It was joke, don't ignore. Pay attention. Then it is a complex in nature. Capital budgeting is very complex in nature, as so many as a huge risk and huge investment in nature. After long meetings and all that, this decision is finalized. Then it is based on the principle of sunk cost. Sunk cost means what? The cost which you have once paid cannot be recovered. So this is the principle of sunk cost. Okay. Let's see. Process of capital budgeting. What are the steps are involved in the capital budgeting process? Let's see. Project identification. First we will see the projects I try to identify. Then evaluation. In this step, in the case of evaluation, we will use multiple different techniques like payback period, average rate of return, net internal rate of return, net present value. So all these techniques will be utilized before selection of the project. Then project will be selected. After, suppose here it is different projects like A, B, C, D. Here what we will do, we will identify, as we identified these ABCDs, then here we are applying the capital budgeting techniques, that NPV. Remember one thing, if one technique is used, is fixed, that this we have to use to evaluate the product. In each project, same technique will be applied. As this should not happen that in project A you are applying NPV, then in project B we are applying profitability index, then in project C we are applying payback period. Such things should not happen. A common technique is used for all the projects. Then only it will give you the reliable results. Then project selection. After selection, after evaluation, you get to know that the project B is giving the best return, so you will select the project B. Then project B will be implementation, that is project implementation, and project performance and review. Whatever the project, how the investment you are in, performance and review of the project you will take after an investment. Okay. So that was all about the process of capital budgeting. Let's see capital budgeting techniques. Capital budgeting techniques are methods to evaluate an investment proposal in order to help the company to decide upon the desirability of such a proposal. Means how much a proposal is desirable to company, how much it will give benefits. So for this, certain techniques are called, methods are used. These methods are used are called capital budgeting techniques. I hope you understood. These are just what methods which are utilized to select the best proposal. Here the capital budgeting, the main factor is considered that is time value of money. The classification, let's see the classification. The capital weighting techniques are mainly classified into two categories: traditional approach and modern techniques. Traditional techniques here involves the payback period and average rate of return, which is also called accounting rate of return. And in case of modern techniques, we have three techniques, that is net present value, internal rate of return, and profitability index. Okay, so here you, in case of modern technique, remember PIN, and here PA in case of traditional technique. This you can payback period and average rate of return, traditional technique, and this PIN. These are the modern techniques. Okay, so profitability index, internal rate of return, and net present value. So this was here a chart is mentioned. Here you can see all more effectively that traditional payback period and average rate of return, and in modern we have NPV, IRR, modified internal rate of return, the for future version of internal rate of return, and profitability index. I hope this is clear. Let's see the first technique, average rate of return. It is all average rate of return is also called as the accounting rate of return technique. The average rate of return techniques considers mainly the profit. If you asked in the exam, key both profit and loss will be considered, no, only profits, and that is not only profits, the average of the entire profits which the project earns in its future life, that all years profit will be considered, and their average will be the main aspect for evaluating the project. Okay, so it considers entire life of the project. Then it is relation between the average annual profits and investment. This this is average investment, I am writing in short, and divided by initial investment. This is the formula used to calculate the capital budgeting through ARR. ARR method formula, it's this. I have it in next slide also. Then it ignores time value of money. Time value of money is not considered in case of ARR. Then it involves accounting treatment. As the name suggests that accounting rate of return, this is the another name for this technique, average rate of return. So it involves some accounting treatment. Then next topic point is the net profit after tax and depreciation is considered while calculating the average rate of return. While calculating the average rate of return, suppose this is your EBIT, that is earning before interest and tax, where you get find the profit. So this profit will not be considered. Here the interest will be reduced. Then you get EBT, sorry. Then the tax will be paid, and after this you will get the EAT, exact earning after tax you will get, and the average will be taken of this EAT. Average EAT, remember this, key earning before interest and tax will not be considered as a whole profit for this. The after depreciation and taxes and interest, after payment of all these three things, the average profits will be calculated. Okay, then expressed in percentage. As the name suggests, it's a rate, then it will also always be expressed in terms of percentage. That's all for average rate of return. Let's see, in case of average rate of return, what will be the decision rule? What type of decision rule will be taken? If the ARR is greater than the cutoff rate, the project will be accepted, or else if the cutoff rate is less, if the ARR is less than the cutoff rate, the project will directly rejected. Okay, the formula for ARR is average profit into 100 divided by net investment. Okay, so always remember that the profit will be considered, that is earning after tax. Okay, suppose this is the EBDIT, this DIT section will be totally reduced, and after that you will get EAT, earning after taxes. This will be the base for the profit for calculating the average profit. Okay, there are some steps involved in determining the payback period. Let's understand them. First of all, we will determine the what is the initial investment. Then after that we will determine what are the cash flows after tax in per year, then determine the military frequency of the cash flow after tax, then we will determine the frequency of the cash flow after tax. Later on, the next determine the year which exceeds the initial cash. If suppose your initial cash flow investment is 10 lakhs, and when in the suppose 4th or 5th year you get the money that is 6 lakh 11 lakhs, your total, the cumulative total becomes 11 lakh. This is the year you will determine, and after that you will take the decision to whether to accept or reject the project. Okay, let's discuss the formula of payback period. That payback period is mainly two formulas are used. In case of constant cash flows, we will use the initial investment or the original cost of the assets divided by cash flow, and if the cash flows are not constant, they are even or uneven, that payback period is determined by using the formula year before the break even plus unrecovered amount divided by cash flow in previous year. I hope you understand the payback period technique. Payback period. Now let's discuss the net present value, most important, very frequently asked in exam. It is also known as net asset method. Remember this name, net present NPV is also called as NAV, that is net asset method. Then it is the modern method of capital budgeting. Now onwards modern methods are started because they are considering the time value of money. Then it is the discounted rate is considered for the computing the net present value. Here we consider a discounted cash flow, and is discounted rate is the discounted rate is the rate of return or the expected rate of return or present value factor. Here we consider the discounted rate has multiple names like present value factor, cost of capital they will give in the question, but now practical as not asked on this topic. Earlier it was asked. Then this is the best method for mutually exclusive project. Mutually exclusive project simply means that one project will be accepted and at the same time another project will be rejected. Then it considers the entire life of project. NPV considers entire life of the project. It is used in case of even or uneven cash flow. Whether the cash flow is constant or not, NPV can easily be used. And the calculation in case of NPV is very complex because you have to see the multiply the cash flows through discounted factor, and again sum of all those cash flows in all year is subtracted from the initial investment. Okay, this will give NPV. So here if the NPV is positive, the project will be accepted. If the NPV is negative, the project will be rejected, and if the NPV is zero, the indifferent, we will consider some another factors. So formula to determine NPV is present value of cash inflow minus present value of cash outflow. Okay, the present value, the present value is calculated is equal, present value factor is equal to C upon 1 plus R raised to power n. Okay, I hope it's clear. Let's see the second last technique, profitability index. So profitability index is also called as time adjusted evaluation method. Remember this point, it can be asked by changing the name. So it is also called time adjusted evaluation method. It tells the value on 1 unit or 1 rupee. It is the most cheapest value because most beneficial method because you can get the value of the project in 1 rupee only. It is also called benefit cost ratio and considers the time value of money. Then modern method of capital budgeting. These are the points related to profitability index. Then what will be the decision rule? In case of profitability index, if the profitability index is greater than the 1, we will accept the project, and if the profitability index is less than 1, we will reject the project. The formula for determining the profitability index is present value of cash inflow divided by present value of cash outflow. Okay, the present value of inflow divided by cash outflow. This is the formula for calculating the profitability index. Then fifth technique comes internal rate of return. Internal rate of return is the modern methods because it considers the time value of money. Then This is also known as the time adjusted rate of return. This is also called as time adjusted rate of return, yield method, trial and error method, and hit and run approach. These are all other names of the IRR method. Remember this. Then it is the rate where the NPV is 0, and IRR is the certain rate where the net present value and becomes 0, and here it is the rate at which the cash flows is equal, inflow is equal to outflow. Okay, and considers the time value of money. This is points we are observing. So the rates are decided internally. The rates for finding the IRR are decided internally. So let me give you an example. Suppose we have two projects, and the given rate is 11% and 12%. So what we will do, we will calculate the value of same project on 11% and 12%, and then whichever is less we will consider it. Okay. Let's see the IRR decision rule. IRR, if expected rate is if internal rate of return is greater than the expected rate, we will accept the project, or if it is smaller than the expected rate, we will reject the project. Formula to calculate IRR is equal to RA plus NPV A upon NPV A minus NPV B bracket multiplied by RB minus RA. Here what are the things mentioned? Let's see. RA is the lower discount rate chosen, then RB is the highest discount rate chosen, and NA is the NPV at rate A, and NB is the NPV at rate B. Okay, I hope you might have understood. So let's understand what's dividend. Dividend, if you see this word carefully, the dividend, what it means, divide in the end. Okay. So what actually dividend means? Ki whenever a firm earns profit, a certain portion of the profit is distributed among the shareholders. That we say that it's the dividend which is being distributed among the shareholders. Okay. So let's understand. A dividend is the distribution of part of the company's earnings to class of its shareholders as determined by the company board of directors. How much dividend have to give by the company will give, how much portion of earning will be distributed, this is decided by the board of the directors of the company. The decision to pay the dividend is based on the amount of after-tax profit. This point is most important, that the after-tax profit will be distributed, not directly the EBIT will be distributed. As we had discussed yesterday, suppose if this is your operating profit, earning before interest and tax, EBIT. So what we will do, suppose if it's your earning, this involves all the three things. One second. This is your main earning. So it involves, it means that is earning before depreciation, interest and tax. Here what you will minus, first you minus the depreciation. Then you will get the EBIT, earning before interest and tax. Then you will lose the, reduce the interest. Then you will get the EBT, earning before tax. Then you will reduce the tax, and you will finally get the earning after taxes. The portion of this EAT, earning after tax, will be distributed among the among the shareholders. Okay. The portion of this EAT will be divided, not the EBIT, because EBIT includes all the interest and taxes which the company has to pay after earning the profit. So after deduction of the interest, tax and depreciation, the EAT, the portion of EAT will be distributed as dividend. I hope this concept is clear. Let's see what are the different types of dividends are available. So cash dividend, stock dividend, scrip dividend, property dividend, share repurchase, and liquidating dividend. These are some the types of dividends which we generally use by a company. Okay. So let's understand from here. I hope this is clearly visible. So let's see cash dividend. Cash dividend is the most commonly used type of dividend. This dividend is commonly used here. The dividend is paid in the form of cash. As per the terms, the company pays the dividend in terms of cash. Okay. Then second comes bonus share. Bonus share is also used by the company. Here it is a company issues issues a surplus share when they have low operating cost. When they have low operating cash, shareholders receive additional shares from the company side. So this is about this bonus share. Bonus share means extra shares will be given to the shareholders instead of the cash dividend. Okay. Then share repurchase. Share repurchase means buyback of the own shares by the company. Here, in case of share repurchase, as the name suggests, repurchase, the company buybacks its own share. Then reduce the number of the shares outstanding. Whatever the shares are outstanding, the company reduce its figure by taking them back from the shareholders. Okay. Then property dividend. Property dividend is the payment made in the form of assets. Instead of cash, instead of any share, a company pays makes the dividend available in the form of an asset. So this is property dividend, and the value of the asset is restated as per the time of payment. The value of the asset will be restated at the time of payment from the company side. Property dividend is generally not practiced in our India. Okay. Very few companies use this type of dividend. Otherwise, mostly cash and bonus dividends are paid. Next comes scrip dividend. Scrip dividend, in case of scrip dividend, a promissory note to pay that the dividend will be paid later is given from the company to the shareholders. Okay. It is used when there is a hard crunch, where the company's earning is not enough, and so they provide a promissory note where it is clearly mentioned that the dividend will be paid later. Okay. Let's understand the liquidating dividend. Here the liquidating means everything fine. Liquidating dividend means return of the original capital dividend. So as a dividend, the company, whatever the amount the shareholder has given at the initial period, the company returns his original capital, and as a dividend, instead of dividend, they return whatever the investor has invested in the beginning in the company, whatever was the original capital of company. So liquidating dividend, as the name suggests, here the company's position is getting worse and it is going to end its life. So this dividend is seen as a sign of closing of the company. Whenever a company closes, it uses the liquidating dividend to return the original capital as a dividend. I hope all these types may be clear to you. So let's understand what is dividend policy. Now we had seen the types of dividend. Now here comes dividend policy. So a company's dividend policy dictates that the amount of the dividend paid out by the company to its shareholders and the frequency with which the dividends are paid out. So here we see, in case of a dividend policy, that how much what is the amount of the dividend is we see, and what is the amount of the dividend we have to pay, and how frequently the dividend will be given. This is decided in the dividend policy. Okay. When a company makes the profit, they need to make the decision on what to do with it. Whenever a company makes a profit, they have to take the decision what to do with it. They can either retain the profits in the company, in the form of retained earnings on the balance sheet, or they can distribute the money to the shareholders in the form of dividends. Either they will retain the money which they have earned, or they will be distributed as they will distribute it as a dividend. Okay. Let me tell you here on this slide. So what actually it means. So here the company ABC, it has made a profit of 10 lakhs rupees. Now it has both the choices. It may retain this whole 10 lakhs or it will distribute in form of dividend. Let's understand what will be the consequences if the company retains or if it distributes. Suppose if a company has to expand its own business, it will retain the earning. No, the dividend will not be paid. But if a company has to attract the future, in future to that the investor should come and invest in the company and become the shareholders. So at this time, the dividend will be distributed so that the market position of the company will improve in the marketplace. Okay, the position of the company, the goodwill of the company matters a lot in a market. So it will only be enhanced by distributing the dividend, not retaining the dividend. Okay, so suppose hope there are a company does not pay dividend for a longer time. So the positions that people feel people don't like to invest in such company, but which a company is giving dividend at regular time intervals for a specific amount is decided and it is being given from a long time, the goodwill of the company will be high as compared to company which is not paying dividend regularly. Okay, so let's discuss the dividend policies. We have 4 dividend policies: regular, stable dividend policy, irregular dividend, and no dividend. These are the 4 types of dividend policies which we have to understand. Let's understand one by one. So what is the stable dividend policy? A stable dividend policy is the easiest and the most commonly used. If it's asked in the exam that which type of dividend policy is easiest and most commonly used, mark the stable dividend. Okay, the goal of this policy is steady and predictable dividend payout each year. Every pre-decided amount will be paid every year in the form of stable, in case of stable dividend policy, which is what the most investors seek, which is what the investor, whether the earnings are up or down, the investors receive the dividend. It does not matter what the company is earning in that particular financial year. The company will have to pay the fixed dividend which it has at regular intervals, which he has decided as per the stable dividend policy. Okay, either company earns in lakhs or loses in thousands or loses 10,000, the company will have to give the dividend in case of dividend policy anyhow. Okay, in case of stable dividend policy. Then we have regular dividend policy. In this type of dividend policy, profit distribution to the shareholders is made at the usual rate at regular time interval. Here the usual rate and at regular time intervals, the dividend will be distributed as per the regular dividend policy. It's very simple. Then irregular, it's just opposite of regular dividend policy. In this type of dividend policy, companies don't pay dividend regularly. Companies don't pay dividend regularly due to various reasons. There are certain reasons where the company is not paying the dividend regularly, such as the liquidity. Liquidity means the conversion of the products into cash, sales into cash. Then volatility, in the future earnings, there is some company is feeling some fidelity that what will be its future earning, etc. And in fact, the companies following the dividend strategy are exactly opposite in the nature of the company, which is with regular dividend policy. The position of the company who is using the irregular dividend policy will not be much better rather than a company who is using the regular dividend policy. The goodwill of the company of this company, whosoever is using the regular dividend policy, will be better as compared to the company using irregular dividend policy. Okay, they don't have the history of stable earnings. The company, here, keep this point in mind, the company whose stable earnings are not there, they uses this type of policy, that is irregular dividend policy. Okay, then last comes no dividend policy. As the word suggests, that here not dividends are not paid. Okay, the type of dividend uh, distribution policy is, this type of distribution policy is followed by the company that requires the capital for funding attractive future growth and opportunities, or to support the liquidity stretch due to unfavorable working condition position. Here, what does it try? It's trying to say that the future, that the no dividend policy will be adopted by the companies which wants to grow in the future, and they have good opportunities, and they have to support the liquidity stretch, whatever they are facing, and they have their working capital which is used to perform the day-to-day operations is very less. They have to bring the working capital position in a favorable form. These companies do not pay any dividend. Okay, here any sort of dividend is not provided to the shareholders. So this point is very simple. In case of no dividend will be paid either regularly, neither regularly nor in a specific amount. Okay, I hope these four types are clear. Let's understand the main thing, that is dividend policies, dividend models, and dividend theories. All these things, either they mention policy, whether they mention model or they mention theories, this is the everything same. So dividend policies are, or the dividend theories are generally categorized into two parts. Two main parts are there. One is irrelevant theory and another is relevance theory. The irrelevance theory, what does it mean? That if the dividend you give, it will affect your, it will not be in case of the regular relevant. In case of relevant dividend policy, if you pay the dividend, it will affect your value of the firm. Okay. But in case of this irrelevant dividend policy, the dividend being paid has an independent effect, has no effect on the value of the firm. Okay, so here in case of irrelevant policy, we have only one theory, that is Modi ji, not Modi ji, our PM Modi, jokes apart, but here the Modi Galani Miller is the we have to study in dividend irrelevant theory, and in case of relevant theory, we have to study GW. Okay, that is Walter model and Gordon model. Okay, we have to study in case of dividend relevant theory, and in case of irrelevant theory, we have to study the Modigliani and Miller hypothesis. Let's understand one by one. Let's understand the Walter model. Walter. Okay. Jokes apart. So this model was given by James C. Walter. James C. Walter, remember this name? The Walter model was given by the person named Walter who eats a lot of James, which we used to eat when we were in child position. In our childhood, we have ate a lot. So it's Walter model was given by James C. Walter. That it's the relevant model of dividend. It's a relevant model of dividend. This is also you need to remember. And dividend affects the value of the firm. What did Walter say? That he said that the whatever dividend the firm will pay, it will have a direct impact on the value of the firm. If dividend is paid, the value of firm will increase or vice versa. Suppose if a company pays the dividend, its value will increase. But in case a company who is not paying dividend will not have any impact on the its value will decrease. Okay. Let's understand this point once again. When the company who is paying the dividend will have a positive impact on the value of the firm, but the company who is not paying the dividend have a negative impact on its value of the firm. It highlights the relation between R and K. R and K R we have discussed yesterday, that is internal rate of return, and K we have discussed. K means the cost of capital. That is internal rate of return and cost of capital are the two major aspects which are being studied in case of Walter model. Okay, then IRR is the internal rate of return and K is the cost of the capital. Okay, then it is also called share valuation model. This name also, keep this mind in name, because sometimes the examiner changes the name and asks the question. So Walter model is also named as share valuation model. Okay, so all these things normally, in case of, always remember what will be asked from these theories and these topics. Number one, it's assumption, most important. Then who is the developer? Okay, then the formula. Okay, and then any sort of relation or condition. Just these are the four things which you have to remember. That is assumption, who is the developer, then what is the formula he has given, and what is the relation or the conditions, and where what type of dividend will be paid. Let's understand the condition relations in Walter model. Before that, let's study the assumptions of Walter model. Assumptions are specifically most important of the Modigliani-Miller model. Every time they have asked. Okay, but we need to keep in mind all the assumptions of the different dividend model and the capital structure theories which we have, and the CAPM, APT, and Henry Markov's risk analysis model. These are the most important models of which the assumptions of which models should be on our tips. Then only we will able to score marks from such type of questions. Okay, then let's understand the Walter model. Walter model says that the all financing done by the retained earnings, no external financing will be used. He said कि whatever financing we need to do, we will do by using the retained earning. No external debt will be used. Okay, means no external financing will be used. Then business risk is constant. Here the business risk will be constant. Then IRR and K means the internal rate of return and cost of capital will be constant. Fourth point says that the company has indefinite perpetual life. Suppose if in place of the indefinite you see definite in exam, that statement will be totally incorrect. So remember, a company's life is indefinite as per Walter model. Okay, then earnings of the firm are either distributed or reinvested. Suppose here the word reinvestment also means that retained. Okay, then the earnings of the whether either the company's earnings will be distributed as a part of as a dividend, or the earnings will be reinvestment for the future growth. Anything can happen. It was the assumption by James C. Walter. Okay, then the EPS and DPS does not change. It will be constant. The earning per share or the dividend per share will be constant, and there will be no taxes. This assumption is totally common in case of any type of dividend theories, that there will no taxes will exist. So let's recall in quick. Let's make a quick recall. In case of Walter model, the financing will be done through retained earnings. No external sources will be used. Then business risk will be constant. IRR and cost of capital will be constant. EPS and DPS does not change. Then no tax exists. Then earning of the firms are either distributed or reinvested, and company has an indefinite perpetual life. I hope now the assumptions will be, you will not forget. So let's understand the three conditions which happens in which is seen in the Walter model. So here a firm has passes through three stages, that is growth firm, decline firm, and normal firm. In case of decline firm, in case of growth firm, the internal rate of return will be greater than the cost of capital, and here the correlation between the market price of the share and the size of the dividend will be negative. So you have to remember this as it is. And what will be the decision? That the 0% payout, no dividend will be paid. In this, the first case where the return is maximum greater than the cost of capital, here 0% payout will be there. means no dividend will be paid. Then in case of decline firm where the company is losing, so making losses. So in this case, the return is less than the cost of capital. The internal rate of return will be less than the cost of capital. Here there is a positive correlation between the market price of the share and size of the dividend. This will be positive correlation, and 100% payout will be there. The principle behind the 100% payout is that company is not getting much money, not earning much money. So she pays the dividend so that they can attract the shareholders in future to invest in that company, by which they can get some funds. Okay. So this is the motto behind the 100% payout in case of decline firm. Okay. I am telling this because such type of things can be asked in the assertion reason type questions. Okay. Then in case of normal firm, in normal firms, the R and K have equal. They are both are independent. Return internal rate of return is equal to the cost of capital. Here no correlation is there, and the decision optimum payout will be there. Okay. I hope this chart is clear. Here all the conditions are mentioned. Let's understand the mathematical representation formula by Walter. Walter has given a mathematical model for the above made statements, whatever assumption he made here. So the formula is P is equal to D upon KE plus R by KE, E minus D upon KE. Okay. So this formula, if you write once or twice or thrice, you will keep in mind. Okay. What does P indicates? P indicates the market price of share. Then D indicates the dividend per share. R is the rate of return on the firm's investment. K is the cost of equity, and E is the earning per share. Okay. Let me check. Just here is some. No, that's only the correct formula. Here what has happened, that the equity financing, they have internal financing will be used. Na? So in the retained earning is also mentioned of the in form of equity. So KE represents the cost of equity, E is equal to earning per share, then R is equal to rate of return on the firm's investment, D is the dividend per share, and P is the market price per share. Okay. So I hope this Walter model is clear to you. Then let's understand the Gordon model. Gordon model was quite similar to the little bit similar to the Walter model, but here there is a minute difference. The Gordon model given by Meron J. Gordon also supports the doctrine of the dividends are relevant to the share prices. It is also says that if a company pays dividend, it has a positive impact on the it has a certain impact on the value of the firm. Here the dividend capitalization model is used to study the effects of the dividend policy on the stock price of the firm. Here what this model is has the another name, that is dividend capitalization model. A certain capitalization rate will be used to understand that what is the impact of the dividend policy on a stock price of a firm. This is the main difference between the Walter and the Gordon model. Then this is also known as dividend discount model. Gordon model is also known as dividend discount model, means just have a three names. GDC. Okay. GDC means this is Gordon model, then this is dividend discount model, and this is dividend capitalization model. So just GDC, who has given a person who has wear a maroon color shirt has given, and was sitting in the garden, that is Meron J. Gordon. In this way, you can understand the name of the author who has given all the three models, that is GDC, Gordon model, dividend discount model, and the capitalization model. Okay. Then let's see the next point. It is used to determine the intrinsic value at the intrinsic value of the share is determined at a given rate. Okay. Then this is a relevant approach and also called bird in hand theory. So the Gordon model is also called as bird in hand theory. So you have to remember here four things. What? G, B, C, and D. G, B, C, D means generally, let me tell you the mnemonic how to remember this, because these are the different names of this model which may be asked in change and it may confuse you. So see, generally the capacity of CD is in MB, but here the capacity of the CDs in case of Gordon model is in GB. Okay, then here again the same thing I am repeating again and again so that you should remember this. That is capitalization model, discount model, Gordon model, and bird in hand theory. So this is the whole concept of this CDGB. Okay. So it is also called as bird in hand theory. Let's understand the assumptions. Assumptions we have to keep in mind as it is. Gordon model has based on the following assumptions. The firm is an equity firm. In case of that Gordon, in case of Walter, the financing was done by the retained earnings. But in case of this Gordon model, the whole equity financing will be done. Okay. Then there is no external financing available. There is no external financing available. Then the internal rate of return of the firm is constant. Constant IRR will be there. Then the appropriate discount rate K of the firm remains constant. Here it is repeating the same things that the IRR and K will be constant. Okay. Then the firm and its stream of earnings are perpetual. It simply means that the life of the firm is the indefinite. Okay. Then the corporate taxes do not exist. There are no taxes, no corporate tax exists, and the retention ratio B once decided upon is constant. Thus, the growth rate G is equal to BR is constant forever. This is the main additional assumption provided by Meron J. Gordon in his model, that the retention ratio, which is denoted by B, and what is the formula for B? G is equal to BR. Gabbar, you remember, it will be helpful because G for retention growth rate and G has the formula BR, and BR here the B is not B, here the BR is not that BR which people used to have in bar. Jokes apart, but here the B is the retention ratio. So remember, whenever we talk about the Gordon model, remember Mr. Gabbar. Okay. Then K is equal to BR is equal to G. It has a condition is not fulfilled. If this condition is not fulfilled, we cannot get the meaningful value of the share. If the K is greater than BR, the cost of capital is greater than BR and it is equal to G. If this condition is not fulfilled, the value of the firm, the meaningful value of the firm will not be determined. Let me tell you in differently. So here I am writing, this condition is very much required to be met successfully. That is K is equal to 9. 1 second. That the cost of capital should be greater than the retention ratio and it should be equal to growth rate. If this condition meets, we can say that the value of the stock can be easily determined. Okay. This condition is very much necessary to be met to determine the meaningful value of a stock. So let's understand the quick, let's take a quick glance of the assumptions of Walter model as they are very much important. It is based on all financing is done through equity mode. Then external financing is not done. No external financing is done. IRR and K both are constant. Then firm has a perpetual life. Then no tax exists. And the retention ratio B and the retention ratio is constant, and thus the growth rate G is equal to BR. Gabbar is also constant forever. Okay, G is equal to BR is K is greater than BR is equal to G if this condition not met. the value can be meaningful value of the stock cannot be determined. So these are all the assumptions of Gordon model. Let's understand the reason behind bird in hand theory. Why the theory is this? Why this model is called as bird in hand? Investors are rational. There are certain reasons behind this, that the investors are rational. Then investors are risk averse. Risk averse means they don't like to take the risks. So here the investors are risk averse. They don't want any risk, and the future, they think that the future is uncertain in case of amount and timing. In case of the future, in case of the amount and timings, the future is uncertain. So what an investor thinks, that whatever we are getting, we should take it right now. It doesn't matter whether the price is high or not. The price is not the concern. Whatever we are getting, we should get it now. So the last line is most important. Investors prefer the current dividend rather than the higher dividend at the future. Okay. Here it is not present. This point is future. So last point I will repeat once again. So investor prefers the current dividend rather than the higher dividend in future. Okay. Suppose, for example, if a person is getting the share price at 110 rupees, so he will buy. Instead of buying a share which cost 90s, and in future he will get a dividend of rupees 50 on it. So instead of this, if he will buy the share which price has rupees 110, and the dividend currently being paid is only 20 rupees. So he will pay the premium price but takes the dividend which is offer at this time, because they don't want to take risk in case of future benefit. Let's understand the formula given by Meron J. Gordon. P is equal to EI 1 minus B divided by K minus BR. Okay. So P is the price per share, K is the cost of capital, EI is equal to earning per share, then B is the retention ratio, and 1 minus B is the payout ratio. Okay. So G is equal to BR, growth rate, R is equal to internal rate of return. Okay. So Gabbar, you remember, G is growth rate, B is retention ratio, and 1 minus B is the payout ratio. Okay. I hope this model is clear to you. Then Modigliani-Miller dividend theory. Let's understand this. It is most important from the exam point of view. It was given by Franco Modigliani and James Miller. It is the irrelevance theory of dividend. This theory was earlier the Walter and Gordon were relevant theories, but this is the irrelevant theory. Then the dividend policy does not impact the value of the firm. The value of the firm is independent of the dividend policy of the firm. Okay. The value of firm is affected by the investment policy of the firm. This point is very much important. Who will impact the value of the firm? The investment policy will impact the value of the firm rather than the dividend policy. Okay. This point you should keep in mind, that the value of the firm will be affected by investment policy, not by the dividend policy, because these are some confusing points which you should have unless you have a thorough understanding, you may get confused while attempting such questions in exam. So always remember that firm has an impact of firm, the value of the firm will be affected by investment policy, not by the dividend policy. Okay. Then investors do not check the dividend history. Investors do not pay attention what type of dividend are being paid in the past trend. So the last point come, market price of share does not affected by the dividend. Whatever the dividend is being paid, the MPS market price of share will not be influenced. Let's understand the assumptions of Modigliani-Miller model, dividend theory. So perfect capital market exists. It's the common assumption that the perfect capital market will exist in case of either it is capital structure or it is dividend theory. The Modiglani Miller has said that the perfect capital market will exist, which is in reality, it's just a myth. Then here the investors are rational. Here the no transaction cost are there. Then the free to access the information, investor are free to access. Then no large investor influence the market securities. Low large investor influence the market securities. Then no taxes. Assumption 2, no taxes. Then third is the investment policy is not changed by the company. The investment policy will be constant as it's not changed by the company, and investors are certain about the future market price and the dividend. Here they have given a major assumption. He has given a major assumption that investors will have investor will be know in advance what will be the future market price and what will be the dividend they will get. So this model was the irrelevant model, but its assumption are most important. Many times they have asked from question from this, specifically the assumptions. All the three models which we have discussed, mainly the assumptions and formulas are important. Let's see the formula of Modiglani Miller model. So here P0 is equal to D1 plus P1 divided by 1 plus KE. In bracket 1 plus K whole divided by 1 plus KE. Okay. Then P0 is the prevailing market price of the share. K0 is the cost of equity. K is the cost of equity capital. D1 is the dividend to be received at the end of the period 1. And P1 is the market price of the share at the end of the period 1. So this is all about the dividend policy, dividend theories, which we have studied. All this topic is very much important from the exam point of view. Just there are only three models which we have to study, that Gordon, Walter, and what is that? And this Modiglani Miller model. Their assumptions are very important and their formulas are very important, and developers. I have told earlier, these three things, if you keep in mind, you will easily can attempt any type of questions asked from these dividend theories accurately. Let's understand what is working capital management. As the name says, working capital management is defined as the current asset minus current liability is a business tool that helps the companies effectively make use of its current assets and maintain sufficient cash flow to meet the short-term goals and obligations. Okay. What is working capital? Basically, in common terms, if anyone asks you, you will say just this current asset minus current liability is working capital. But what is management of working capital? The management of working capital mainly suggests that the difference among the current assets and the common liability should be used effectively as a business tool to fulfill your short-term requirement of current assets and to maintain a cash balance to fulfill your short-term goals and obligations. Okay. So let's understand what is working capital. That was working capital management in here. Now it is working capital. Working capital is that part of firm's capital which is required for the financing the short-term current assets such as current marketable securities, debtors, and inventories. Funds thus invested in the current assets keep revolving fast and are constantly converted into cash, and this cash flow out again in the exchange of another current assets. Working capital is also known as circulating, revolving, or short-term capital. So these are the some names of working capital, that it is also called as revolving capital, then circulating capital, and short-term capital. This you can remember by this mnemonic WCRS. Okay. So working capital, circulating capital, revolving capital, and short-term capital. What does working capital management simply means that the use of current assets and to effectively meet the use of current assets and current liability to as soon as the converted into cash, and so that we can buy a new current asset in exchange for it. Okay. So why working capital is needed in an organization? In an organization, the main reasons behind the requirement of working capitals are to fulfill the short-term debt obligations. The company wants to fulfill its short-term obligations, so it needs the working capital. Then applying for surety bond. Just a second. So we applying for a security bond. We have, if you have to apply for a security bond, you need some working capital because some certain amount is needed to be deposited. So this for surety bond, you need working capital. Then growth and expansion. As you know that the working capital fulfills the purpose of day-to-day operations in an organization. So if an organization wants to grow and to expand its business, it will require the working capital to fulfill its day-to-day requirements. Then emergency preparedness. Emergency preparedness working capital is very much important. Certain amount of a working capital is kept aside because in case of any contingent situation, we can use that working capital to fulfill the necessities at that time. Then seasonal differences. Seasonal differences are very much suppose some products are seasonal and the manufacturing firms use this seasonal working capital to fulfill that, but at the rest of the time when the season is over, they have to maintain a certain amount of working capital to fulfill the monthly or daily requirements like rent, electricity bills. These are not part of working capital. It generally considers the current assets and current liabilities, but some of the current assets are also required when the season is not there. So to meet that requirement, we need working capital. Last one, attracting the investors. If an organization has a good amount of working capital, the investor will attract towards the organization to invest and to buy its share. Okay. So let's discuss the importance of working capital management. Now, in the previous slide, we discussed the need of working capital. Now we're discussing the importance of working capital management. It improves the liquidity and solvency position. A firm's liquidity and solvency improved as per if it manages the working capital in a proper way, then ensures uninterrupted business operation. If you have you are maintaining a proper amount of working capital, managing it properly, then your business operations will flow smoothly. Okay, then increase in profitability and productivity. Your productivity and the productivity of an organization and the profitability improve as per the proper maintenance of working capital. Then goodwill, as the working capital position amount is good, the goodwill in the market will also enhance. Then improves the credit worthiness. Credit worthiness, suppose you want a loan, then at that time the financing institutions will give you the loan because they know that you have sufficient amount of working capital, and anytime if they you will repay the loan as per the repay the credit as in the given period of time. Then timely payment of dividends. Timely good working capital helps to pay the helps in the payment of dividends of the preference shares. Generally, it is the in case of equity shares, the dividend is not either paid or not paid regularly, but in case of preference shares, a certain amount is required to pay the dividend. Okay. So if the company has some scarcity of funds, this working capital can be used to pay the dividends. Okay. Then helps in financing, facing the contingency. Facing contingency means an undesirable situation occurs in an organization. For suppose the coronavirus consequences were there, whole India was locked twice for 2 years, twice for 2 months. So in this case, if we had maintained a proper working capital, we might faced it effectively. Then here comes the classification of the working capital. Classification of working capital is important to understand because generally it is very basic things, but if you if any one conceptual question asked from these types, we can easily able to answer in from the on the basis of the concepts, or we have gross working and net working capital. Then on the basis of time, we have permanent and temporary working capital. Then this permanent working capital is categorized into this regular working capital and reserve working capital. And in case of the temporary variable or variable working capital, here it is categorized as seasonal working capital or special working capital. So remember, you have to remember किसमें क्या आता है, because such odd one out questions can also be asked from this classification chart. Then let's see types of working capital. Types of working capital is the we have permanent working capital. It is the minimum working capital required for the producing the predetermined production. Whatever the production is predetermined from the organization side, the minimum working capital which is required to produce it is permanent working capital. Then temporary working capital. Temporary working capital is the additional current assets required for the temporary period, and it is above the permanent working period. Always remember that the amount of the permanent temporary working capital will always be greater than the always be greater as compared to the permanent working capital, because we are using it, even it is the additional current assets. Additional is word is mentioned na? So you have to remember that these are the additional current assets required for the temporary period. Temporary period is the main keyword to identify the temporary working capital. Okay, let's understand the gross and net working capital. Gross working capital is the sum of the all the current assets appear in the balance sheet. Whatever current assets company is using, as mentioned, he mentioned in the balance sheet. So the summation of all the current asset will be termed as gross working capital. Current assets are these assets which can be easily convertible into cash. So this we all know that the assets which are easily converted into cash is current assets. Then net working capital concept we discussed. Then it is the difference between the current asset minus current liability. CA minus CL is simply current liabilities are the short-term liabilities. This we know. Then regular working capital. Regular working capital, this is defined as the least amount of capital required by the business firm to fund its day-to-day operations of the business. Example includes the payment of salaries and wages, then overhead expenses for the processing of raw materials. So what is regular working capital? Which is the amount least amount required to fulfill the day-to-day operations of the business. Okay, it is regular working capital. Then seasonal working capital. This refers to the increase in the amount of working capital business needs during the peak season of the year. When the season, when there is peak season of the year, suppose in case of woolen clothes, they have January, November to February period is their peak time. So here they need more working capital. So the this type of working capital which is being only used in the season, in a particular season, it is called seasonal working capital. A business may never have to borrow fund to meet its working capital needs. So here in case of seasonal working capital, if it maintains a proper amount of working capital, they will not meet don't need to borrow any additional capital for as a working capital. Such a working capital specifically meets the demands and of the business having a seasonal nature. This working capital is only be used in case of the business to fulfill the requirements of the season. Okay. In case of a business which is of seasonal nature, this seasonal working capital will be used. Let's see reserve working capital. Apart from day-to-day activities, a business may need some amount of capital for unforeseen circumstances. For means contingency events. If any type of contingency event occurs, a business, some amount of funds are kept separately to use at that time. So reserve margin working capital is nothing but the amount of capital kept aside apart from the regular working capital, the amount which is separated from, suppose this is your 10,000 is your regular working capital, and you are keeping rupees 2000 aside. So this is your what? This is your reserve working capital. Okay, I hope the concept is clear. Then special working capital. Supplementary working capital may also be required for the business to undertake the exceptional operations or unforeseen circumstances. Sometimes the supply exceeds in and you have to produce more. Sorry, sometimes the demand exceeds as compared to supply and you have to produce more. At that time you will need some extra working capital. This is termed as the special working capital. Supplementary working capital may also be required to the business to undertake the exceptional of operations. Then the capital required for such circumstances is termed as special working capital. Suppose your production is everyday production is 10,000 units, but if the customers are increasing and they are more, they are getting more for this is can be easily used, mainly used for the seasonal goods, and the customer base of the company increases and then the production turns into 15,000 units per day. So the amount which is required to 5,000 extra to produce the 5,000 extra units, this unit will be funded through the special working capital. Okay. Then here again the summary is given. Gross working capital we have seen, summation of the current assets, then net working capital, current assets minus current liability. Permanent or fixed working capital, it is the level below which the working capital is never gone. This point keep in mind. In case of permanent working capital is the least level below which the working capital does not go. Okay. It is further divided into regular and reserve, which we have discussed, and temporary working capital, no working capital, or the permanent working, net working capital minus the permanent working capital is the temporary working capital. Okay, temporary working capital is also known as variable working capital. Remember this name. It is further divided into seasonal working capital, special working capital. We have discussed these points. Let's see the main difference between the differences between the gross and net working capital. Net working capital is qualitative in nature. Remember this key differences, because these statements, these differences become base for the statement type questions. Okay, it is qualitative in nature, and the gross working capital is quantitative in nature. Okay, then net working capital indicates the firm's ability to meet its operating expenses and the current liabilities. Okay, then net working capital is mainly used for the to meet its operating expenses and the current liability. Then gross working capital indicates the total amount of available for funding the current assets. As it's the formula tells us it is the summation of current assets, so it is the amount available to fund the for the funding of current assets. Then third point comes, it expresses the current assets minus current liability. The formula based difference is there, and it is indicating the total sum of the current assets. Here CA minus CL, and here sum of CA. Okay. Then fourth point comes, it is suitable for the sole traders and partnership firms. Net working capital is generally used for the sole trader or the entrepreneur person or a partnership firm. Then it is suitable for the companies. Gross working capital is very much required for the companies. Then next point comes that it is useful to find out the true of the financial position. It is useful to find the true position of financial position of the company. What is the true financial position of a company will be told by the net working capital, and it cannot renewal the true financial position. Gross working capital will not indicate the true financial position. Why? Because it is not including the current liability. It is only dealing with the current asset. So it won't be able to tell the financial position of the company. Okay. I hope you understood. Let's, if you want, you can take the screenshot of this chart. So here are the formula mentioned: gross working capital, sum of current assets, and net working capital, current asset minus current liability. Now here comes the most important topic of working capital: approaches of working capital investment. So there are three AMC. AMC is the aggressive, moderate, and conservative. Aggressive working capital, moderate aggressive approach, moderate approach, and conservative approach. These are the three approaches of the finance working capital investment. So let's see aggressive approach to working capital financing. There was the sorry, this word was should be investment financing. This is not investment, this is financing. So these are the approaches of financing of working capital: aggressive, moderate, and conservative. Okay, let's discuss the aggressive approach to working capital financing. The aggressive approach in high risk is the high risk strategy of working capital. It's the high risk strategy of the working capital. Then in this case, when the short-term finances are utilized not only for financing the temporary working capital, but also the reasonable part of permanent working capital. Here what happens, here company is taking a risk. Why? Because they are using the short-term sources of finance to fulfill the requirement of both the temporary and permanent permanent working capital. Okay, let's see the advantages and disadvantages. The advantages that low financing cost and high profitability. Here the profitability will be high and low financing cost as the short-term sources are used. Then lower carrying and handling cost. The carrying cost and handling cost will also be low. Then highly efficient working capital management. Working capital will be managed efficiently. Okay. The disadvantage. What are the disadvantage of using the aggressive approach? Insolvency risk. As the short-term sources are being used, so there is a high risk of insolvency. Then lost opportunities and unexpected shocks. If you use the current short-term sources of finance for financing both the temporary and working capital, then at this time you are taking the huge risk and it may result in undesirable consequences. Okay, I hope this your aggressive approach is clear to you. Let's understand the conservative approach. What does conservative? Conservative are risk-free. Here the company is not like don't prefer to take any risk. Conservative approach is the risk-free strategy of the working capital financing. A company adopting this strategy to maintain the higher level of current assets and therefore the higher working capital. In this case, the working capital is financing. The company is adopting the strategy to maintain higher level of working assets. Here the more current assets will maintain to a good level there, and therefore it will result in a higher working capital. Then what is the financing strategy? Financing strategy means long-term sources will be financed. Long-term sources will finance the fixed assets plus permanent working capital plus the part of temporary working capital. Then short-term funds will be financed that the remaining part of the temporary working capital. Whatever temporary part of the temporary working capital is remaining, they will use the long-term sources of finance to both, they will use the short-term finance to fulfill the temporary working capital, and permanent working capital will be used to finance the long-term sources will be used to finance the permanent working capital. In short, I am writing here that the permanent working capital will be financed through long-term. Okay. And the temporary working capital will be financed through short-term. Okay. So this is the whole crux of the long-term, conservatives. Then advantages and disadvantages. The smooth operations with no stoppage. Here you are using the appropriate sources. So here there will not be any interruption in your business. The flow of the business will be smooth. Okay, then no insolvency risk. Here we are using the appropriate measure, so there will be no risk of insolvency. Let's discuss the disadvantage. Disadvantage: higher interest costs. The interest costs are very high. Then funds are kept idle. Then here higher carrying cost. The carrying cost is also high, and the inefficient working capital management. The working capital management is inefficient. Okay, I hope this clear. The interest rate will be high, interest cost will be high because the long term sources are being used, so the interest will be high. Okay, let's discuss the matching approach. Maturity or matching approach suggests that hedge risk by matching the okay, hedge risk is matching the maturities of the assets and liabilities. The permanent current assets are financed through long-term financing, while the temporary current assets are financed through short-term financing. Okay. So here it is said that this aggressive is little bit different. I told here the about the matching. Here the matching suggests that the short term the main concept which I told at previous slide. The temporary working capital will be financed by short term, and the permanent working capital will be financed through long term. Okay. Here there is no excess funds. No excess funds are there in case of matching. Now this chart will clear you the difference. Liquidity is high in case of conservative approach. Aggressive approach, liquidity is low. Then in case of hedging or matching, it is balanced. Okay. Then profitability. Profitability is low in case of conservative, and the aggressive approach, it is more because the risks are takers. Only the short-term financing is used to finance both the permanent and temporary working capital. Then hedging, it will be balanced. Okay. Then risk is very low in case of conservatives. Then aggressive approach, the high risks are there, and in case of hedging or matching approach, there will be balanced. Okay. Then asset utilization high in conservative, low in aggressive, and in case of hedging it will be balanced. Then working capital is more requirement is more in case of conservative. In aggressive there is low, and in case of hedging that will be balanced. Okay. Now let's see, this chart will clear you. I have added one more chart so that the concept will be clear. In case of matching, matches the maturity of the assets with the maturity of financing. Then in case of aggressive, short-term temporary capital, capital to finance some permanent working capital. And in case of conservatives, uses long-term permanent capital to finance some temporary working capital. In case of conservatism, only the long-term finances will be used to finance both the temporary and permanent capital, working capital. Okay, that's why the interest cost is high. Let's start one by one. So first we discuss what is portfolio management. A portfolio management is the art and science of selecting and overseeing a group of investments that meets the long-term financial objectives and risk tolerance of a client, a company, or an institution. So what is generally the word portfolio simply suggests that this is our portfolio. This is and here we are different securities are available. So in this multiple, where one should invest to get at a minimum risk and at a maximum return for a long term. If one wants to invest, how we should invest. So this is the main concept discussed in the portfolio management. In portfolio management, we want with less risk, we want to earn maximum return. Then we discuss risk management. What is risk management? Risk management is the process of identifying, assessing, and controlling the threats in an organization's capital and earning. These risks stem from the variety of sources, including the financial uncertainties, legal liabilities, technology issues, strategic management errors, and accidents and natural disaster. So what this risk, there are in any type of organization, a risk, different type of risk are involved. So risk management, we identify the risk, we try to assess the risk, and we try to control the risk which are related to our capital and our earnings. For example, in 2020 and 2021, coronavirus was a huge risk for the all type of organization, because due to which at least 2 to 3 months all type of organizations all over the world were locked. So such, to avoid such type of uncertainties, to manage these situations, we have to do the risk management. Okay. So now here a comparison, we are going to compare the systematic risk and unsystematic risk, because this is going to help to understand the CAPM model. Systematic risk refers to the hazard which is associated with the market or market segment as a whole. Systematic risk, what the means suggests, it relates with the system. It's a hazard which is associated with the market and the market segment as a whole. Okay, it is related, talking about the capital market or exchange market. Then unsystematic risk. Unsystematic risk generally associated with the organization. It is unsystematic risk refer to the risk associated with the particular security, company or industry. Whenever we talk about a specific thing, it is related to the unsystematic risk, and whenever we talk about the whole market, it will be in case of systematic risk. Okay, the nature of systematic risk, it is not under control, it is uncontrollable. But in case of unsystematic risk, the risk can be controlled by taking some effective measures. Then the factors, external factors are responsible for systematic risk, but internal factors are responsible for the unsystematic risk. Then if affect systematic risk affect large number of securities in the market. Large number of securities are affected by the systematic risk, and only the particular company is affected by unsystematic risk because it states the specificity. Then types: interest risk, market risk, and purchasing power risk. These are the examples of systematic risk which are not in our control. Then unsystematic risk. Unsystematic risk are the related to the business risk and the financial risk. These are unsystematic risk. Then the protection to asset allocation is the measure which can be used to avoid, protect from systematic analysis. And portfolio diversification is the measure which can be helpful to manage the unsystematic risk. Okay, to avoid unsystematic risk, we can use the portfolio diversification, whereas we will invest in multiple securities so that our risk will be diversified. Risk will be reduced through diversification. I hope this difference is clear. Let's begin with the capital asset pricing model. Most important. The capital asset pricing model, CAPM, describes the relationship between the systematic risk and expected return from the assets, particularly the stocks. Okay. So what CAPM model tells, it describes the relationship between systematic risk and expected return for the assets. Suppose in exam it comes, it states the relation between the unsystematic risk and expected return. The statement will be totally incorrect because only the unsystematic risk will be considered. Then CAPM is widely used throughout the finance or pricing risky securities and generating expected returns for the assets given risk of those and the cost of capital. CAPM is also known as the best measure of for measuring the equity source of capital. It is the best measuring tool for measuring the equity for the cost of measuring the cost of equity share capital. Okay, if it asks in exam which among the following is the best measure of equity share capital, so mark it as CAPM model. Okay. Then who are the developers of CAPM? This option recently in the past 2 to 3 exams, this is asked. These names are very important because this is asked in exam n number of times. So who are the developers of CAPM? William Sharpe, John Linter, Jack Tonier, and Mosim. So to remember this name, you can relate is that CSLTM. CSLTM, if you remember, that is CAPM, William Sharpe, then John Linter, then Jack Tenier, and Mosim. These are the four people associated with this model as a developer. Then let's discuss the assumptions of CAPM, which is also very much important. Investors make the investment decisions on the basis of risk return analysis. The investors are, this means investors are well informed. They make their investment decision on the basis of risk return analysis. Then point 2, the purchase and sale of the security can be undertaken in indefinite divisible point, in infinitely indivisible points. Once again, I am repeating, the purchase and sale of the securities can be undertaken in infinitely divisible units. Okay. Then point 3, the purchase and sale by a single investor cannot affect the prices. If any single investor is making the purchase and sale, doing the transactions, it will not affect the security prices. Okay. Then there is no transaction cost. No transaction cost or no flotation cost exists as per the assumption of CAPM. Then there is no personal income taxes. No income taxes will exist. Then the investors can lend and borrow any amount of funds at the risk-free rate. The investors lend and borrow any amount of funds at the risk-free rate. Point 5, the investors can sell the short any amount of shares. In short term, any amount of shares can be sold by the investor. Then last point says the investors share the homogeneity of the capitalizations from the market. There is a the investors share the homogeneity of expectations. The expectations of the multiple of multiple investors trading in a common market is almost common. Okay, there is a homogeneity in expectations. Remember, this point is very important. These assumptions are most important from exam point of view. You have to remember as it is. Once, twice or thrice you will read, you will be able to answer the question asked if it asks in exam. Then understand what is beta in CAPM. Beta is, this is not beta, your or my son. This is beta. Beta is the major, it is the represent beta. This is the main sign of beta. It generally represents the systematic risk, which is uncontrollable in nature. Beta is the measure of beta is the measure of systematic risk. Beta is the standard CAPM measure of the systematic risk. It gauges the tendency of the return to the security move parallel with the return of the stock market as a whole. What is it's telling? That it is a main factor through which the main factor in the CAPM model, which measures the tendency of the return to the security move parallelly with the return of the stock market. It compares the stock market and the whole and the portfolio market as a whole. Okay, through beta. This factor is mainly considered while comparing the stock valuation of a single stock with the whole market. Okay, then one way to think the beta is as a gauge of a security is volatile relative to the market's volatile. That's I have just told you now that the beta gauges the volatility of the security and of the whole market. Okay. I hope it is understood. Now let's see this chart is very much important. I have made it easier for you. When the beta is equal to 1, then the expected return of stock is equal to expected return of the market portfolio. Then when beta is greater than 1, the nature of the investment will be aggressive. Then the expected return of the stock will be greater than the return of the market greater than the expected return of market portfolio. Then steeper slope of the characteristic line. It's given for in next upcoming slides. What is characteristics line? I have separately mentioned. So here what happens when the beta is greater than 1, the nature of the investment will be aggressive. The investment is aggressive in nature. Then the expected return of the stock is greater than the expected return of the market portfolio, and this results in the characteristics line slope is steeper. Okay. Then the third point comes when the beta is less than 1, the value of the beta is less than 1, then the investors will be cautious and there will be defensive investment. Why? Because the expected return of the stock is less than the expected return of the market portfolio. And here the slope of the characteristics line will be flatter. Okay. I hope it is clear. Let's see the formula of CAPM. CAPM, the formula is also asked once or twice, and sometimes they give a numerical which is very easy on this based on this formula. CAPM formula is expected return is equal to risk-free rate plus beta into expected return on expected market return minus risk-free return. Okay. I hope it is clear. Expected return is equal to risk-free rate plus beta multiplied by expected return expected market return minus risk-free return. So what does ER represents? Expected return. Then RF represents risk-free return. Then beta represents the market risk, and ERM represents the expected market return. Okay. I hope this is clear. Then let's see the merits and demerits, that is advantage and disadvantage of CAPM. CAPM eliminates the unsystematic risk. As we discussed earlier that unsystematic risk is not considered in CAPM, only it considers the systematic risk. Okay. Then the third point, investment appraisal. Before an investor can appraise it, check the position of its investor, whether it is taking he or she is taking right decision or wrong with the help of this CAPM model. And ease of use. CAPM, as there is a single factor involved, it is can be used easily. Then what are the drawbacks? Drawbacks is that the too many assumptions are there in this CAPM model. Then point 2, assigning the values to the CAPM variables. We need to assign the different values to measure the risk for as to the CAPM variables. Okay. What we are doing, we are assigning the values to the variables involved in the CAPM. Then the point 3 is ability to borrow at risk-free rate. It's the ability to borrow at risk-free rate is less. Then determination of project proxy beta. Sometimes error may happen, so determination of project proxy beta. Let's see another conditions and their respective decisions. If the value of CAPM is less than expected return, the decision, we should buy the security. Why? Because the stock is undervalued, and the nature of the return that is that the stock is generating the more return as compared to what it should give. Okay. Then the CAPM is greater than, when the value of CAPM is greater than the expected return, we should sell the security because here the stock is overvalued. Then the less return, then the what it should give. We are getting the less return than what it should give. Okay. Then CAPM is equal to expected return. We should hold the securities because the stock is correctly valued, and here the exact return what it should give, it is giving. Just a second. So this is the diagram of CAPM model. Here on the horizontal axis, we see beta of the market, which is equal to 1. And on the vertical axis, we see the risk-free rate and the market return. If this portion states that risk-free rate is normally taken as the yield as a long-term government bonds in the country where the project's company is based. Okay. Then on this line, just a second. Here the risk premium between the 3% and 99% risk premium is mentioned in this diagram. Then here the market return is mentioned. Okay. Then this is the diagram again. This is the efficient. This is not that much clear. Some slides I had added. Yes, this one we have to discuss, that what is security characteristics line. A characteristics line is a straight line forward using the regression analysis that maximizes the particular security's systematic risk and the rate of return. What is the, it is the regression, that is cause and effect relationship is being seen by using a straight line, which is telling us what is a particular security's systematic risk and the effect on the rate of return. The characteristics line is also known as the security characteristics line. Remember that this name, sometimes they give security line and sometimes they give security characteristics line, but both are same. Okay. Then next paragraph says the characteristics line is created by the plotting the security return at various points in time. The characteristics line is created by plotting the security related to the various points of time. Okay. The y-axis on the chart measures the excess return of the security, and excess return is measured against the risk-free rate of the return. This is very much important. The excess return is measured against the risk-free rate of return. The x-axis is the short measures, the x-axis measured on the chart measures the market return in excess of the risk-free rate. Let me show you the chart again. Here we had seen on the y-axis, it measures the market return, and on the x-axis, it's measure the beta of the market, that is the risk. Okay. Same thing is, it's given little bit opposite. Security market line. Let's discuss what is security market line. Security market line is a line drawn on a chart that serves as a graphical representation of the capital asset pricing model CAPM, which shows the different levels of the systematic or market risk of the various marketable securities plotted against the expected return of the entire market in any given time. So you have to just remember the security market line is what the graphical representation in the CAPM, which shows different level of systematic or the market risk of various marketable securities. The securities which are marketable in nature, the levels of their systematic risk or the market risk is being plotted separately as per the security wise and the expected return of the entire market. here what we are comparing? We are comparing the market return at given time and levels of security. Sorry, levels of systematic risk. Levels of systematic risk of marketable securities. I hope this is clear. Then later comes the capital market lines. We have seen till now security characteristics line, then security market line. Now we are seeing the capital market line. The capital market line CML represents the portfolio that optionally combines the risk and the return. Capital market line is a broader concept that represents the portfolio and optimally combine the risk and the return. It is the theoretical concept that represents all the portfolios that optimally combine the risk-free rate of return and the market portfolio of risky assets. It optimally combines the risk-free rate of return and the market portfolio is of the risky asset. Under the capital asset pricing model, all the investors will choose the portion on the capital market line. The position will be chosen on the capital market line in equilibrium by borrowing or lending out the risk-free rate, since it maximizes the return for the given level of risk. Let me tell you in easy way. What is capital market line is telling? It's the first of all, it is the combination of the risk and return. Okay. Then it is representing all the portfolio that combines the risk-free rate of return and the marketable portfolio of risky assets. Then here the investors, what we will do, they will choose the certain positions on the capital market line. It will indicate an equilibrium position which can be achieved by borrowing or lending at the risk-free rate, since this maximizes the return for the given level of risk. At that level of risk, you can earn the maximized return. It's indicated by the capital market line because investors will choose their equilibrium position. Then we discuss the arbitrage pricing theory. Then we are here, our CAPM model ended. Now we are beginning with the arbitrage pricing theory. Arbitrage pricing theory was given by Stephen Ross in 1976. Arbitrage pricing theory is the multiple factor asset pricing model. This CAPM was only one factor was there, that is beta. But here multi-factor asset pricing model, this is the APT is the multi-factor is the model based on the idea that assets return can be predicted using the linear relationship between the assets expected return and a number of microeconomic variables that capture the systematic risk. So what is this APT telling? APT is used where the assets returns are predicted using the linear relationship between the expected return and the different macroeconomic factors which are associated with the PESTEL, that is political, economic factors, or technological factors. These are all the macroeconomic factors, and this also includes the systematic risk. Okay. Because systematic risk, as we seen in the chart, that is, it is uncontrollable or undiversifiable. Okay, then it is useful tool for analyzing the portfolios from the value investing perspective. It is also a tool. It is also helpful in analyzing the portfolio by from the investors' perspectives in order to identify the securities that may temporarily mispriced. By this we can check which securities are temporarily mispriced. At that time, this arbitrage pricing theory is highly utilized. Let's see the assumptions of APT. APT has not that much many assumptions like CAPM. The capital markets are perfectly competitive and no transaction cost. This assumption makes the possibility that the arbitrage of mispriced security, thus forcing an equilibrium price. Okay. Here, what is the assumption one states that the in the perfect competitive market, their capital markets are perfectly competitive and there is no transaction cost. Here it is stating the possibility. Here it is stating the possibility of arbitrage of the mispriced security to here. So here we have to bring it to the equilibrium price. Point two: investors always perform more wealth to less wealth. Investors always prefer more wealth to less wealth. Okay. Then point three, various factors give rise to the return on the securities and the relation between the security return and that the factor is linear. There is linear relationship. Remember this point, the return, rise in the return of from the securities and the relation between the security and the return will be in the among the macroeconomic factors will be linear in nature. This stochastic process generating the asset return can be expressed as a linear function of the set of the risk factors or indexes. Okay, indexes can be used to measure the linear relationship. Okay, so these assumptions are quite lengthy as compared to CAPM model, but we have to do a root learning as possible, because there, in case of these assumptions or theories, we don't have any other choice. Like in derivative, we had studied that we have call option or put option, but here there is no choice. You have to just learn by heart these assumption, because any type of question can be asked in the exam. So let's understand the factors. APT formula is quite more lengthy as compared to CAPM. APT is the alternate to the capital asset pricing model. Stephen Ross developed the theory in 1976. The APT formula is ER is equal to RF plus beta 1 RP1 plus beta 1 to RP2 plus beta 3 B3 RP3 plus beta P4 and plus RP5. These are the factors. Here the factors are mainly increasing. ER means the assets expected rate of return. Then RF is the risk-free rate. Then F is the sensitivity of the assets return to the particular factor. Sensitivity is represented by the beta. Then the FP is the risk premium associated with the particular factors. Okay. It is the risk premium associated with the particular factor. Okay. RP is the risk premium. Okay. So here, as there are multiple factors, so the risk premiums are also increasing. I hope you have got the formula and the APT theory. Now we are at the last slide, that here we are comparing the APT and CAPM. So point one says the APT holds, then there is no arbitrage population. When there is a holding stage, then there is no arbitrage opportunities. The CAPM model is based on an inherently unobservable market portfolio. CAPM is based on the unobservable market portfolio. Then APT pricing relationship is quickly restored even if only the few investors are recognized an arbitrage opportunity. If any few number of investors are who recognize the arbitrage opportunity, then relationship can be quickly restored. But in case the CAPM rests on the mean variance efficiency, the actions of many small investors restore the CAPM. Here, many small investors the number of small investors will be high, but in case of APT, the number of investors will be low to restore the equilibrium position. Okay. Then the third point comes, the expected return minus beta relation, the expected return and the beta relationship can be derived without using the true market portfolio. Without using the true market portfolio, we can derive the expected return and beta relationship. But in case of CAPM, describes the equilibrium for all the assets. CAPM describes the equilibrium for all types of assets. I hope you might have first understand what is derivative. Actually, as the word suggests, in derivative refers to what? Here, a little spelling is there. Sorry for that. This T is not there. It's derivative. Okay. The term derivative stands for a contract whose price is derived or is dependent upon an underlying asset. Deriving a value from an underlying asset is called a derivative. Okay. The underlying asset should be a financial asset such as currency, stock, and market index, and interest bearing security, or a physical commodity. The derivatives are of different, the following things are covered under the derivative market, like physical commodities, market index, interest bearing securities, or the currency or stock. Okay. So this is the concept of derivative, because first of all, unless we start from basics, we will not be able to cover the few things which are stated forward. Then we have, what is the difference between the spot market and derivative market? Derivative market is little bit different from the spot market. Spot market is what? Suppose I have to buy ice cream. As the summer season is going on, that's why I'm giving this example. So what I will do, I will go to the ice cream parlor, offer him the money or pay it through the Paytm, and take the ice cream and come back. On spot dealing will be done. But I cannot say him that भैया ये लो 10 रुपए ले लो, मैं आइसक्रीम कल लेके जाऊंगा. ऐसा होगा क्या? नहीं होगा ना ऐसा, क्योंकि आइसक्रीम तो उतने देर में आइसक्रीम का राम नाम सत्य हो जाएगा. उतने देर में पूरी आइसक्रीम की वाट लग जाएंगी. My money will be wasted. So in case of spot market, the transaction takes place immediately. What is traded in the what is exchanged in the spot market, the financial assets are traded. In case of derivative market, financial instruments which are known as contracts are exchanged in the derivative market. Okay, there are examples also given in spot market, like cryptocurrency, stocks, foreign exchange currencies. These are traded in the spot market. But in case of derivative market, futures, forwards, options, and swaps, these are traded in the derivative market. Don't worry, these things are in detail in the upcoming slides. Then time horizon. Executed immediately. Spot market is in case of spot market, the transaction is executed immediately, and in case of derivative market, it is executed at a specific time interval, at a specific future date, or after a specific time interval. Then we have complexity. The complexity of spot market is straightforward. There is no, it's not complex. Just go pay the money and take the thing. But in case of derivative market, these are highly complex, as the lot of risks are involved in the derivative market. The n number of the formalities are there, so these are complex. Then again, the same point is mentioned, complexity. The flat crypto exchange regarded the pure crypto exchange isn't. Okay. Then it is fully regulated. Derivative, remember this point can be asked in exam. The spot market is not well regulated, but derivative market is fully regulated. Okay. Let's understand who are the parties involved in the derivative market. Derivative markets, we have generally three parties who are involved in the derivative market, like hedgers, speculators, and arbitrators. The hedgers are the player whose objective is risk reduction. These people are afraid of risk, afraid of taking the risk, so they are risk averse in nature, and they trade in such a way that they should not face any contingent problem due to as they kept the risk lower. Okay. Then we have speculator. Speculator are the players who establish position based on their expectations of future price movements. Okay, they are speculators are those person which do not afraid to take risk. They like to take risk and they want to earn money, so they establish their such a position based on their expectations on the future price of the moments. Okay, then arbitrators are the these are the players whose objective is to earn the profits by selling in by pricing in differentials. Okay, let me tell you in another slide. Just see here. One we have the hedger, one we have the speculator, and one we have the arbitrator. Okay, these are the three people. Hedger are risk averse. Then speculators are, the risk is like girlfriend in case of speculator, risk lovers. Okay, and the arbitrage are the most rascal people, because what they will do, whatever the difference is between the prices, whatever this price difference between the prices, to earn profits, they will sell the commodity, buy in one market and sell at higher rate. I am writing in short. In other. Okay, I hope now it's clear. Hedgers are the people who don't like to take risk, but the speculators are risk lovers, so they take much risk. And arbitrage are the people who check the differences between the prices, and to earn earn more profit, they buy in the one market at lower price and sell in another market at higher price. Okay, I hope this is clear. Let's see some concepts regarding the arbitrage, some points regarding the arbitrage and speculators. Arbitrage is the process of the simultaneously buying and selling to take the advantage of price and yield differentials. Okay, I told you earlier that these people work on the price differential and take the advantage from another market. Then speculators. Speculation is the process of taking an open position and hoping that, example, the exchange rates will move towards the expected direction. Okay, exchange rates will move towards the expected directions. Then spot market speculation, forward market speculation, and option market speculation. So these are the people who will deal in the spot market, at the in the forward market, and in the option market. But the arbitrage, but the hedgers, in case of hedgers, if you say hedger people who are the hedgers, who are risk averse, they will deal in the future market. Okay, देखो, जो हेजर रहेगा वो फ्यूचर मार्केट में ट्रेड करेगा, जो स्पेकुलेटर रहेगा जिसको रिस्क से बहुत प्यार मोहब्बत है, वो कहां ट्रेडिंग करेगा, वो स्पॉट मार्केट में अपनी डीलिंग करेगा, फॉरवर्ड मार्केट में डीलिंग करेगा, एंड ऑप्शन मार्केट में डीलिंग करेगा, बिकॉज वो क्या चाहता है कि मैं ज्यादा से ज्यादा रिस्क लूं और ज्यादा से ज्यादा प्रॉफिट कमाऊं. बट दो आर्बिट्रेज रहेंगे, ये क्या रहेंगे, ये सबसे हलकट लोग रहेंगे. ये क्या करेंगे, ये जो अपनी बाइंग एक मार्केट में खरीदेंगे कम प्राइस पे और दूसरे मार्केट में जाके उसको बेच देंगे हायर प्राइस से, ताकि जो बीच का डिफरेंस है उससे वो प्रॉफिट ले सके. आई होप यू माइट हैव अंडरस्टूड. Now let's understand what is OTC, that is over the counter, and exchange. What is the difference? Then first let's understand the meaning. Over the counter, OTC is the decentralized dealer market, whereby the broker and the dealer transact directly in the computer networks and phone. Okay, this is the counter-based transaction, where the dealer decentralized one, where the dealer and the brokers and the dealer transact directly from the computer networks and phone. Okay, then in case of exchange is the organized and regulated market, whose wherein the trading of the stocks takes place between the buyer and the seller in a safe, transparent and systematic manner. I hope like the Bombay Stock Exchange is there, national stock exchanges are there. These are what? These are well organized markets where the buying and selling of different currencies take place. Okay. Then in case of market maker, who OTC is the dealer and the exchange is the exchange itself. Okay. Then the OTC is used by small companies and exchange is used by well-established company. Okay. Then in the physical location, on the spot, over the counter has no physical existence, but the exchange has the physical existence. Okay. Then the trading hours for the over the counter transactions is 24/7, and but for the exchange hours, this is exchange hours for. This is for exchange hours. Like in our India, the exchange market is available for, in my opinion, it's from 9 a.m. to 3 p.m. I don't know the exact timing. I don't trade in this market. So, but in my opinion, it's 9 a.m. to 3 p.m. Okay. Then stocks. Then unlimited stocks can be traded in over-the-counter market, but the limited stocks are allowed to trade in the exchange market. Then we have transparency. The transparency in OTC is low, but the transparency is comparatively high in the exchange market. Let's understand the contract. The nature of the contract in the OTC is customized. They are customized contracts, but in case of exchange market, these are standardized contracts. Proper standards are followed in this exchange traded market. I hope this is clear. Now let's see the types of contract in derivative. The most important one, that is forward contract, future contract, options contract, and swap. These are the four main types of contracts in the derivative. Okay, let's understand one by one. Forward contract. These are the promises to deliver the asset at the predetermined date in future at the predetermined price. Remember this point. Key in case of forward contract, whenever we talk about the forward contract, an asset will be determined, of which the price will be predetermined and the date will also be predetermined. Okay. Then forwards are highly popular on currencies of interest rate. Forwards are highly popular on currencies on interest rate. Okay. Then these contracts are traded over the counter. OTC we have discussed just now. These contracts can be traded over the counter, that is outside the stock exchange markets, directly between two parties, and are customized according to the needs of the parties. Here what will happen, two parties will there, they will agree on the contract themselves and their conditions will be decided among themselves. Okay. Since these contracts do not fall under the preview of the rules and regulations of the exchange, they generally suffer from contemporary risk. Contemporary risk means there is a high chances of contingency because they don't fall under the any follow the any rules and regulations related to exchange market. Okay. Then the risk, the default risk is high in the case of the forward contract. Okay. They may not be if one party do not fulfill the other's obligation. Let me understand. Let me give an example for you from where you will be able to understand properly. For example, let me change the pen color. So we are discussing the example. So let's discuss. Here is one person. Party A. Okay. And here is another person. My drawing is not like you, but try to understand. Now what happens? He says that they are dealing in case of crops. Okay. So they are dealing in crops. He said that after 3 months, I will give you 3 quintal wheats they are dealing in wheat at the rupees 5,000 per quintal. इतना महंगा तो होता नहीं है, but we are just discussing an coincidental example, so we are discussing. But what happens? They made an agreement and a contract, but after 3 months, if this person goes to him, just a second. So what happened if this person goes to him after 3 months? 3 months later, then and he rejects कि हमारे बीच में तो ऐसा कुछ हुआ ही नहीं था. He rejected कि हमारे बीच में तो ऐसा क्यों नहीं हुआ, कुछ हुआ ही नहीं, and he take the money in advance. This person had taken the money from him in advance. So क्या हुआ, रिस्क ही तो हो गया ना उसके लिए. इसने तो बोला कि इसने तो पैसे दे दिए कि मैं इतने पे लूंगा, बाद में अगर ये मुकर गया, if person A disagrees that I will not give you, मैं नहीं दूंगा तुमको, तो क्या हुआ, बी का तो नुकसान हो गया ना. बी face the risk. So this is about the forward contract. High amount of risk is involved in the forward contract because the one party may change his opinion at the later period. Okay, so this was the example of forward contract. You might have understood. If any doubt you have, you can ask in the comment section. Okay. Now let's discuss what are future contract. A future contract is an agreement between the two parties who buy or sell an asset at the certain time in future at the certain price. Here the price will be certain and not be predetermined and after certain time. Okay, these are the basically exchange traded contracts and standardized contracts. Okay, these points are very important, that the forward contracts were customized, but these are standardized. Okay, then the exchange stands guarantee to all the transactions and contemporary. If any case happens, this will be said that the exchange stands who are the third party will take a guarantee that they will not make any party to lose. Okay, thus the risk is largely eliminated. There is less risk as compared to forward in the future market. Okay, remember this point. Then the buyers of the future contract are considered having a long position, whereas the seller are considered to be the having a short position. Remember this, the buyers will have a long position and the seller will have a short position in the future market, in the future contract. Okay, future contracts are available on the varieties of commodities, currencies, interest rates, stocks, and other tradable assets. These are highly popular on the stock indices, interest rates, and foreign exchange. Okay, so here what you have to remember that these are standardized contracts. These are exchange traded. The buyer has the long position and the seller has the short position. As for seller, as for short position. B for buyer, B for long. BL and S square. You can remember in this way. Okay. Then the future contracts available at the varieties which are mentioned here, that is interest rate, stock, then tradable sets, high popular stock indices, and interest rate and foreign exchanges. Okay, this was all about future. Now from this chart you will get clear everything. Okay, then for the meaning we have discussed, so I will not discuss it again. What is it? It is a tailor-made contract. Forward contract is a tailor-made contract. Then future contract is a standardized contract. Okay. Then it is traded on over the counter. That is, there is no secondary market. There is no secondary market involved in case of forward contract. But in case of future market, they are well organized and took the exchange. Okay, well organized stock exchange. फ्यूचर जब भी होगा, फ्यूचर वेल ऑर्गेनाइज तरीके से होगा, स्टॉक एक्सचेंज मार्केट में होगा. लाइक देन द सेटलमेंट इज डन ऑन द मैच्योरिटी डेट एंड the settlement is done on a daily basis in the future market. Okay, the risk is high in the forward market, as I gave you the example earlier, that there is default risk is high in case of forward market, but in case of future markets the default risk is low. Why? Because there is third party involved who takes the guarantee that he will not let you lose the money which you are paying. Okay, in case of in exchange of the money, you will get that particular benefit or stock or whatever you are want to be take. Okay, then default, as they are private agreements, the chances of default is relatively high. The chances of as they are, these are privately agreements, so default risk is high, but no such probability of any default risk. Okay, then the size of the contract depends upon the contract terms. The size of the contract depends upon the contract terms, but in case of futures, these are fixed. Okay, then there is collateral. No collateral is required in case of forward contract, but in case of future contract, initial margin is required. Okay, then the maturity, as per the terms of contract, maturity is, can be as per the terms of contract, but in future it can be predetermined date, but future can be traded before that date too. Okay, then regulation is a self-regulatory, as there is no third party involved, but in case of proper stock markets, stock exchanges are involved, so they are well regulated. Okay, these are regulated by stock exchange. Then we have liquidity. The liquidity of forward market is low, but the liquidity of future contract is low. Okay, forward contract, the liquidity is low in case of forward contract, but in case of future contract, the liquidity is very high. So let's this is another chart. Let's understand, is there any separate point? Then this one, mode of delivery. In the last point, mode of delivery, the specifically divided into some result in delivery. In case of the mode of delivery is specifically divided some result in delivery. Okay, but in case of futures, this is standardized. Most contracts do not result in delivery. Most contracts do not result in delivery. Okay, then we have price of contract remains fixed till the maturity. No fluctuations will be there in case of forward contract, but there will be changes will be there in case of forward contract on daily basis. Okay, then size we have discussed, margin we have discussed, then counterparty risk is present, but here in case of future, counterparty risk is not present. Then there are, in case of forward markets, any number of contract can happen, but in case of future market, it is fixed by the exchange, that a certain number is fixed from the exchange markets, exchange trade. Okay, then hedging, tailor-made or specific duties and quantity, but these are done by the using the nearest month or the fixed lots. Okay, fixed lots are there in case of future markets. Rest all the point we have discussed in both the charts. I hope forward and future are crystal clear to you. Let's understand what are swaps. Swaps are the privately agreements between the two parties to exchange the cash flows in the future according to the pre-arranged formula. They can be regarded as portfolios of forward contracts. Swaps are regarded as the portfolios of forward contracts. Here mainly the currencies are traded in the form of cash flows. Okay, there are two types of swap. One is interest rate swaps and second is the currency swap. In case of interest rate swaps, these entail swapping only the interest related to the cash flows between the parties in the same currency. The currency will be same. The principal will not be exchanged. The principal will not be swapped, but only the interest which is to be paid on that principal, that will be swapped. Okay, so it is interest rate swap. Next comes the currency swap. Currency swap, these entail the swapping both the principal and interest between the parties with the cash flows in one of the direction being a different currencies than those by the opposite direction. Here what will involve? Currency will be involved, and both the principal and exchange will be traded. Okay, I hope it's clear, both the currency swap and interest rate swaps. Let's see the last one, that is option contract. Till now we have discussed the forward contract, future contract, and swap. Last comes the option contract. Option gives the buyer or the holder a right to buy, but not to sell. Obligation. Right will be given to the buyer, but not the obligation will be given to buy or sell an asset in the future. A buyer gets a right, but no obligation is given. Okay. Then options are of two types: call option and put option. Call gives the buyer to right, but not the obligation to buy. CB. CB means in case of call, remember the buy option. Okay. A given quantity of the underlying asset. In case of call option, the buyer can buy the given quantity of the underlying asset at the given price, or and before the maturity date, before the future date, it can be buy. But in case of put gives the buyer to right, but not to obligation to sell. PS. This can be remembered easily by using the second, my pen is not working. In case of call, there will be buy, and in case of put, there will be sell. But in both the conditions, there will only be right, but there will be no obligation. This point is most important. Right will be there, but no obligation will be there. In case of call, you can buy the currency, but in case of put, you can sell the currency. Okay. Sorry, underlying asset, not currency. It gets the underlying asset on the price before the given date. Okay. Option has a expiry date. Always remember, no, in case of future and forwards, there was no concept of expiry date. But in case of options, there is a concept of expiration date. Okay. The buyer has the long position, in the seller has the short position. This point you should remember. The buyer has the long position and the seller has the short position. Then let's see the next points. It should be noted that first two types of contracts, that is forward and the futures, both the parties, the buyer and the seller, have an obligation. In case buyer needs to pay for the assets, and the seller needs to the seller, and the seller needs to deliver the asset to the buyer on the settlement date. On the particular settlement date, the buyer has to pay the amount to the seller, and the seller has to deliver the assets. But in case of options, only the seller, also called as option writer, is under the obligation and not the buyer. Buyer won't be under the obligation, but seller will be, because being an option writer, he will have the right. Okay. Option purchaser. The buyer is called as option purchaser. Okay. The buyer has the right to buy that is call option, or sell the put option, the asset from us in the buy the asset from, or the seller has the option, but may or may not exercise this right. They can't exercise. Okay. Then increase the in case of the buyer of the options does exercise the right of the seller, option must fulfill whatever this is obligation. For the call option, the seller has to deliver the asset to the buyer of the options. But for a put option, the seller has to excise the assets from the buyer in case of the option. Okay. This last point may not be clear to you. Let's understand this from this chart. Okay, this chart will clear your doubts. In case of call option, it offers the right but not the obligation to buy the underlying assets at the particular date at the pre-decided strike price. Strike price is pre-decided. Then in case of put options, it offers the right but not the obligation for the selling the underlying assets at the particular date for a pre-decided strike price. Okay, the strike price will be pre-decided, but they have right to, in case of put, I told you earlier, selling will be done, and in case of call option, purchasing will be done. Investor expectation, there is rise in prices. Price will rise. The investor expects that in case of call option, there will be rise in the prices, but in case of put option, the investor expect that there will be fall in price. Okay, then profitability. The gains can be unlimited. Unlimited gains will be there since the price rises cannot be capped. Okay, there is no cap on the rising price, so it will result in huge profits. But in case of put options, gaining are limited since the price can fall. Gaining are limited since the price can fall readily, but will stop at the zero. Okay, then what are the next point? Permits. In case of permit, only permits to buy the stock, and the put option only permits selling of the stock. Last point is analogy. Considered as a security deposit, allowing the making the products at the certain exchange, certain fixed price. It means that it is considered that the security deposit is allowed to take the product at the certain fixed price. Some security you have to keep to buy the product in future at certain fixed price. Then in case of put option, it is an insurance offering the protection against the loss in the value. There, if any loss occurs, you have to keep some money in advance to overcome that loss. Okay, then let's see some option terminologies. It's all about root learning. The given option terminologies are all subjected to root learning. You will have underlying is the specific security or assets. Okay, as we have studied. Then what is option premium? The price which is paid extra is option premium. Okay, what is strike price? Strike price, the price which is pre-decided, is strike price. Then what is the expiration date? Date on which the option expires. The options should always be traded before the option expires. Then excise date. Excise date, option is the exercise, the date on which options are excised. And then the open interest. Open interest is the total number of the options contracts that have not yet been expired. Means the option contracts which are outstanding are covered in the open interest. Then option holder. One who buys the option is called as option holder, and option writer is one who sells the option is the option writer. I hope this chart might have cleared the terminologies which are related to option, by which you will be able to understand the different points which are mentioned in the option in this previous slide. Okay. Then let's understand the moneyness in the option. What are the moneyness in this option are given here. Then as we see, whenever the strike price is greater than whenever the stock price is greater than the strike price, in case of call option, it is in the money, but in case of put option, it is out the money. But when the strike price is equal to, when the stock price is equal to strike price, both are equal, it will be, in case of call option, it is at the money, and in case of put option, it will be at the money. Okay, but in case of stock price is less than the strike price, in case of call option, it will be out of the money, and in case of put option, it will be in the money. It's purely opposite. Then one second you wait. I will write it for you, which will more make you clear. Because this call put is really little bit confusing. Here we are talking about call, and we will talk about this put. Okay. So this is what subjected to buying the security, and this is what selling. Okay. Then the next point comes Just a second. If price rises, the profits will also rise. Okay. But in case of put, if the price increases, the loss will increase. Okay. But in case of price, if price reduces, loss will be there. But in case of put, if price decreases, there will be profit. Okay. Then one more point, that is that in the money, out the money. Let's discuss this once again. Where it has gone. I am changing the color so you will be easily understand. This ST is the spot price and SP is the strike price. Okay. I am writing the in short, so I am giving the full form in advance. Okay. Here both will be equal. Then in the third case, here purely opposite things will go. Oh, sorry. I have written opposite. Let me rub this complete. I hope now it is clear. Just make a chart in your notes to just add it to add this in your notes. It will be most beneficial because there is a lot of chance that question can be asked from this chart. So I have provided this summary to you. That is the, in case of forward, there is agreement to buy underlying asset at a specific rate and specific date in future. The forward contracts, the flexibility, more flexibility Then the other derivative contracts are customized forward contract. We have seen that these are customized. These are over the counter traded, and here high contemporary and credit risk is there. Okay, then in case of future, we seen similar to the forward contract, trade on the established exchange rate, trade. Then the fixed format size of the expiration and follow daily settlement procedure. Okay, in case of option, we have discussed just two types of option, call and put. Then right, only right is available, not no obligation. No obligation is available for seller. Options are an obligation. Okay, and the first point is gives the holder right, not the obligation, to buy or sell the underlying asset at a specific rate and date. Okay. Then last comes the swap. Swap is the most indicate the desirable tool. Swap are most indicate the desirable tools. उसके बाद most involves the exchange of fixed cash flow and floating cash flow. Then similar to other type of derivative, swap can be of to commodity, currency, interest rate swap or more. Okay, so this was all about today's topic, that is derivative, forward, future and options and swaps. I hope you might have understood this. This is now crystal clear to you. We will meet in next video. Thank you. Bye. If you like the video, please hit the like button, because your one like gives us a lot of motivation.